Hey guys, it's me, Zeus, and today's video I'm going to break down two trades that I took today. I'm going to break down a market maker sell model trade that I took on the S&P, and I'm going to break down a market maker buy model trade that I took on EU. Is it a coincidence that I'm uploading the same type of video again? No. Why? Well, I want to prove to you that these type of models, these market maker models, appear over and over again, and repetition is key to learning. So that's why I'm posting these type of videos, and I hope that you learn something from them, and I hope that you enjoy them, because I really love creating these type of breakdown videos, sharing my thought process with you. Anyhow, enough of the chatter, let's dive into it. So I started my analysis on the 4-hour chart. My drawn liquidity were these lows. I saw that a CB got created, a bearish fair value gap, and that was my POI. I wanted to see price trade into that during a kill zone, and then I wanted to see lower time frame confirmation to find an entry. Don't feel like it's weird that you don't understand what I've marked up here, but there are so many things that occurred within this simple fractal of price action that you can literally choose your own model and see it play out. Because I'm going to get back to this chart in a bit. Here we see a bearish mitigation block. Could have been your POI or your trade. Target, London lows. This order block could be your trade. Sell here, stop here. Boom. Done. So what I want you to be aware of is that you can literally create your own model, your own rules of engagement. And once these rules of engagement or these criteria have been met, you can execute. It's that simple. And we can both take the same trade, but we can have a totally different reason for taking on that trade. And that's what I love about ICT. But I'm going to give you my breakdown, my thought process, and I hope you will be able to learn something from it. So first of all, just like I said on the 4-hour chart, we were in a bearish delivery. So we were expecting lower prices. Once I saw that price created this consolidation type delivery during the London kill zone, I expected the market to rate the London highs, rebalance that initial 4-hour fair value gap that I was talking about, or rebalance this 15-minute fair value gap here, and then sell off to take the London lows and maybe even take out the previous week low. Well, that didn't happen, but that's not a problem, because this is a really good trade. Because if I dive into the 5-minute chart, I can show you my entry pattern, and you'll be shocked about how clean it was, this delivery. And just to give you a little golden nugget and point you to something, look at this. I'm going to zoom in for you. Do you see this? How well price reacts to this line? I'm not going to dive into the theory behind balanced price ranges today. So I framed my intraday bias, my bias for the New York kill zone. I wanted to see the London high get rated, rebalance this area above here, and then sell off. I even noted in my live execution video, which I'll put up here just for fun, that this was going to be a low resistance liquidity run. Low resistance liquidity run? What does that mean? So a low resistance liquidity move means, just like the name implies, that there is low resistance between the inception of the move and the terminus of the move. So the sell side delivery program started up here. This was the inception of the move, and this was the terminus of the move, the end. Do you see any huge retracements in this whole move? No. Why? If we take a look on the left side of the curve, on the buy side of the curve, of this market maker sell model, we can see that there weren't many retracements. And if there aren't many retracements, retail looks at this as a trendline phantom. Do you see this trend line here? Retail thinks they will extend this and they will think, oh, this is going to continue to move higher. Let's buy here. Let's put our stops below the trend line. Well, we as smart money minded traders know that that isn't the case most of the times. And because we do not really see any real retracements in here, we can expect the sell side of the curve to be aggressive as well. And that's why you see this whole leg down be so fast and quick. And here we saw a SMT with the Dow Jones made a higher high, while the S&P and Nasdaq made a lower high. So that was a signal that this was a smart money reversal. Within that fair value gap, within that order block, within that mitigation block, within that balanced price range. And then we saw the market structure shift, the pattern that I teach publicly for free on the lower time frames. Then we saw our fair value gap get created, another balanced price range. And then a deferred rebalance. Another fair value gap market structure shift, deferred rebalance. Another fair value gap deferred rebalance. 930 UDIS, sell off. How many entries, opportunities do you see in here? Like, damn. I'm going to dive into the lower time frames even more to show you that the market structure shift pattern that I'm talking about was actually there, because here you can see it. Fair value gap, rebalance, trade away. This becomes an intermediate term low. This low gets broken by another fair value gap. Price retraces into this fair value gap, rebalances it, and then sells off. Do you know what I just said? Because this is literally the market structure shift pattern. We saw that the market structure shift appeared, fair value gap, short, stop above here somewhere. Depends, you could place it up here, or up here. Sell off, market structure shift, fair value gap, stop can be placed above this high because this rebalanced this fair value gap. Sell off, market structure shift, fair value gap, rebalance, sell off. Balanced price range here could be your entry, stop above here because this rebalanced this fair value gap. Boom, sell off. I want you to take a look on this chart of the Nasdaq and the Dow Jones, and I want you to pause the video and think about what you see in this chart. Come on, pause it, man. Here's the Nasdaq, here's the Dow Jones. The Nasdaq made a lower high within this fair value gap, while the Dow Jones made a higher high in this fair value gap. So what does that signal? This signals that smart money is within this move. There's a cracking correlation. So this was a high probability smart money reversal. And I've noted the consequent encroachment of this fair value gap, 50% of the fair value gap. And do you see how the market just wicks above it and then sells off? This is a sign that there's a certain heaviness behind the move, behind the whole downwards move, behind the downside delivery. The algorithm is in a rush to deliver lower prices and take out the London lows. And do you see what the Dow Jones did? It consolidated in here. Long wicks, long wicks. So if you wanted to trade one of the indices today, you should have traded the pair or shorted the pair that made the lower highs, so Nasdaq and the S&P, because that was a signal that they were weak. The Dow Jones was strong because it made a higher high. So here we are on the hourly chart for the euro. Even though the higher time frame institutional order flow is bearish, we can still take longs once the market returns to a discount array and there's obvious liquidity or imbalances above market price. I saw that the market traded into this 1 hour order block. I saw that the previous day low got taken out. I saw that the -1 standard deviation of the central bank dealers range got respected perfectly. And then I went into the lower time frames and I saw a market structure shift occur here, another market structure shift occur here, fair value gap left behind. The market rebalances this and then trades away, immediate rebalance and then expands. I took an entry within this immediate rebalance. On the lower time frame, we can see that the market rebalanced this 5 minutes fair value gap. A lower time frame market structure shift occurred, and then I went long within this bullish order block here, target this high, a liquidity void here, and the Asian highs up here. And this was just an enormous trade. I participated in this move while I was outside and I was on my phone. I only paper traded it, unluckily, but that doesn't change a thing about theory being applied to the marketplace, because this is how the markets book. It's that simple. Once you understand how the algorithm delivers price, you can capture these type of moves. And some of you will probably look at this and think, oh, this is hindsight, blah blah blah. Well, here's the execution. Call it hindsight now. Like, I don't get all these clowns that are not accepting the fact that this is reality, that this is the way that the markets book. I think it has something to do with their ego or something like that. I really don't know, because if I would see someone like ICT prove this type of stuff over and over again, and even see his students, just like me, post these type of videos proving that they're applying the concepts to the marketplace, like, that's all you should wish for. So that basically sums up this video. I hope I was able to point you to some new things that you weren't aware of yet. I hope you liked it. I hope you enjoyed it. If you did, I would highly appreciate it if you could leave a like and or a nice comment. I wish you all a great day. Be safe, and I'll talk to you guys soon, Lord willing.